In this video, we're going to talk about a poor man's covered call trade I'm doing this week. I'm going to give you a little peek into my world as to how I found this stock, what my plans are, and I'm even going to show you that I've used this stock 2 times to generate the kind of profits you're about to see right here. Stick around. I know you're going to like this one. Hey, welcome back everyone. It is time for another red hot covered call video. Well, that's right. We are going to talk about the poor man's covered call. I'm going to show you how I use a stock to generate higher than average cash on cash percentage gains. And I'll tell you what, I absolutely love this trade. I've done it 2 times. The stock is trading exactly the way it was before. And what I think is going to happen is the stock could trade sideways to higher. We'll have our shares taken away from us in a mere 34 days, and we can pocket as much as 13%. That's what we're going to talk about today. And then I'm going to show you the monthly dividend paying stock I'm going to buy with those premiums. We literally are generating money. We are printing cash when we use our stocks. We sell premium against them. That premium, that per share premium, is literally like printing money. See, you didn't have it before when you owned the stock. Now you write a covered call against your shares and you have that cash. Now you take that cash and you buy dividend paying stocks. So we have a dividend tree just giving us monthly dividends as if we were picking fruit off the dividend tree. That's what I do every single month. I'm going to show you the stock I'm going to buy with this money. Now, hey, look, before we get going, if you like anything we're doing here at the Retire on Dividends and Covered Call channel, baby, I retired in 2022, 55 years old. I use covered calls and dividends to pay for my retirement. You can too if you learn this, okay? So what I want you to do is subscribe to the channel. I come back every week, show you timely and relevant covered call trades and dividend purchases so we can up the game. And hey, look, while you're there, bang that like button, man. It lets me know you like what I'm doing. Now, what we're doing is this. We're talking about Cisco. I love Cisco's chart. I'm going to show you its chart here in a minute. But first, what I want to show you, I've done this trade 2 times before. So I'm not up here just talking about some random stock that I found on Wikipedia, and I'm going to bore you for the next 10 minutes talking about things so I make that YouTube money. Okay, I'm talking about a real trade that I have done, closed, made profit, and I'm going to show you the trade I'm going to do. I already have it dialed up. I just have to buy the Leaps call option and then place the trade on Tuesday. So here's the deal. In the past, I've used Cisco for poor man's covered call trades, largely because the thing trades sideways to higher. And Cisco, being a networking juggernaut, they don't fall too far off the table if they have a bad earnings. And for the most part, they don't rocket higher like back in the .com days. It's a steady trade that usually trades between 45 and 55. And what I'm showing you here is what the members get when I place this trade. We talk about why I placed the trade, all the profit projections, and we have resources like clicking links to find earnings dates and dividends. And what I love to do is let them know exactly what the initial trade setup showed me in my profitability. Remember in the beginning of the video, I told you I was going to show you what money I could make on this trade? Well, I'm going to show you that here in 1 second. Let's go ahead and go to the chart first because I want to show you how it's trading and why I like it. Now, if you hang with me through this, I'm going to show you the trades that I completed using Cisco for a poor man's covered call last year. So I've put real money in the game, and I plan to put even bigger money in the game, largely because of the way it's trading. So what I want you to do is focus on its last support line. And you can clearly see Cisco, since November of last year, has a support line of around 47x. 47x, Wall Street seems to like it. In fact, you could see when it missed earnings, absolutely bouncing off that number, and then Wall Street let it play around its Keltner channel mid. Keltner channel is a stocks trading range, and if it's trading in the mid, we love that, because if it trades below the mid, we love to get involved. When it trades above the mid, we want to be cautious because it's getting near the top. You can almost think of it as an RSI, where an RSI near 80 is overbought and near 20 being oversold. Right now, it's trading at a 35 RSI, so it's more oversold than overbought. And again, this is Cisco. Okay, we're not talking about some high flyer that has moved 10, 20 points. This thing trades in a range. And yes, it has been peeling off, but look where it's peeling off to. It's peeling off back to that 47 number, right where I want to get involved. And if we move back the chart, you could see a couple things. One, the dividend has passed. So we don't have to worry about a dividend and we don't have to worry about earnings. So this trade, for me, has a clear path for the next 2 months, which means I can buy a Leaps call option 3 months out, use it as protection while I write near-term covered calls against that Leaps call option. Also notice that if we go back even further, we see where Cisco touched a line of support, which was near 47. And for the most part, as it moved higher from last year when the markets were down, you could see it rides that Keltner channel midline. And then we have some earnings, and earnings work both ways, right? We have the fall off here after earnings, and we have the rally here after earnings. Recently, we've had the fall off and the drift since last earnings. So for me, Cisco doesn't have much volatility. This window that it's trading in, although that chart is moving, it's literally between 54 and 47. That is literally a 7-point window. And if played right, we can write covered calls on our shares throughout that little window. Now, of course, I'm talking about a Leaps call option. So I only have until the date the Leaps call option expires. So what we're looking to do here is to use a Leaps call option that is trading about 3 months out. And let me show you what that Leaps call option is. Now, this is the initial trade setup most everybody needs to be using if you're doing a poor man's covered call. You want to get involved in a poor man's covered call trade? I need you to download the Poor Man's Covered Call Tracker and use it. Plug in your numbers so you know what your profitability is on your very first trade. Because if you're using Leaps call options that are not near the 95 and 96 and 97 delta, you are going to find yourself in a bad spot if the stock rockets higher, because remember, the Leaps call option and its delta dictates how it moves based off of a $1 move in the stock. So if the stock moves higher and your Leaps call option is 60 delta, well, it's only going to move 60 cents of a $1 move. You might find yourself lagging, being assigned your shares, and when you sell your Leaps call option to pay for the trade, well, you didn't make as much as you could have. So in this case, we're looking at that 97 delta leap, and that 97 delta leap will move 97% of a $1 move in the stock. So we use that for our calculations. That's very important. This calculator has the delta move built into it. We plug in the numbers in the yellow, and you will get the numbers that you're about to see right now. I'm going to go ahead and buy the July 2024 Leaps call option. So this means that I am going to buy the right, but not the obligation, to take somebody's shares at 35. I have until July 2024 to buy that person's shares or sell this Leaps call option outright. So having that July 2024 Leaps call option gives me the ability to write 30-day covered calls leading into July. Because come July, I'm going to have to make a decision whether I buy his shares at 35 or I sell the Leaps call option. It's that simple. During the time I own this Leaps call option, for which I can buy somebody's shares at 35, I'm going to write near-term covered calls. And in this case, I've dialed up where Cisco's trading at 48.44. I've dialed up the 50 near-term covered call. It's about 34 days, and I'm giving somebody the right, but not the obligation, to take my shares away from me at 50. They're going to pay me 47 cents per share up front. Now, that's a covered call premium. They're going to pay me that. Now, if they take my shares at 50, and mind you, there might be a little slippage. Remember, you have to buy back the option to close the trade, paying more money, and then you have to sell your Leaps call option, for which should pan out these numbers. This trade, if my shares are taken away at 50, I will make about 13.6% or $1,900 on 10 contracts. I would be buying 10 Leaps call options, and I would be paying $14,475. Now, if they do not take my shares and this trade ends without the stock being over 50, that's fine. I will get paid $470. I will keep everything and will look to do the next trade. This trade will expire March 22nd, so I'll look to do another covered call for April 22nd. And we will keep doing this until the stock moves higher, and hopefully I have my shares taken away and my Leaps call option is profitable. I'm paying $14.48. I want to be able to sell my Leaps call option for at least $14.48. But what we're really hoping to do is to have this very first covered call go to expiration, have them take our shares, and we make all of this. If the shares are taken, we make about $1,974. If our shares are not taken, hopefully we can let the trade expire, collect the $470, which by the way is 3.25% in this time frame, and we do it again, and we do it again. Let me go ahead and show you my 2 past trades and how much money I've made. Now remember, go to cptdashboard.com, click free spreadsheet to get your free spreadsheets. In the description below is the brand new Poor Man's Cover Call Tracker. And if you download your copy, you get 1 free month of my membership. cptdashboard.com, get your free spreadsheets. Also check out the upgraded CTP dashboard where I have a 1 free month offer. But how about you click in the description and get your 2024 Poor Man's Covered Call brand new tracker and pick up a 1 free month, no obligation of my membership. Would love to welcome you aboard. All right, we got 2 things left here. I'm going to show you the trades that I've already done. Then I'm going to show you the monthly paying ETF I'm going to spend this money on. I love collecting monthly dividend paying stocks using the semi-passive investment strategy of selling premium. Writing covered calls. If you don't know how to write covered calls, just go to YouTube and search, how do you write covered calls? You're going to find that it's that simple. And when you do it, it's like printing money. People say all the time, I don't have any money to do this. I'm spending bills, this, that, and the other. Well, if you have stocks, you write a covered call. Now you've printed money. Take that money and put it into dividend paying stocks, for which pays you money. I'm telling you what, man, at the end of the day, you have the wealth mindset, you hang with me. That's how we think. Now, here's the deal. Back in April of 2023, Cisco was trading exactly where it's at today. Do you remember in the chart I told you it was trading at about 47x when it hit its support line? Well, look where I was trading it at. I was trading it at 47.21, and I went ahead and bought the 25 strike, and I paid $22.81. I went ahead, bought the Leaps call option, and we immediately wrote the first covered call. Now, it looks like I bought that covered call back and only made about $165. Well, what did I do? I wrote another covered call, and this time the stock moved much higher. Because you're looking at me taking a loss of $830. That means the stock has powered higher. I didn't pick the right strike price because I didn't have the expected stock move calculator built into my tracker back then. But I do now, and what I'll tell you, you can download it. I use it. Here's the deal. I would have plugged in that expected stock move on the upside, and I wouldn't have had the stock power past my strike price. And that's how I do it these days. I will pick that deep out of the money strike, pick up a nice little crumb, and as the stock inches towards that, I'm able to manage the trade. In this case, I must not have been able to manage that trade because I got paid $1.29 and I had to pay $1.66 to get out of the trade. Well, then I decided to do it again. I went ahead and wrote another covered call, picked up $1. Now the stock must have kept going, and here we are paying $1.81. It keeps going higher. We find ourselves in a bad spot when it's time to sell the Leaps call option, because what ends up happening is Cisco continues to go higher and my Leaps call option bails me out. See, this is why we have to buy the Leaps call option in lieu of the shares if you're going to do this simulated share ownership trade, because that Leaps call option bails me out to where I'm able to sell it and make some $4,400 on the sale of the Leaps call option, pocketing for the entire trade some $1,900. Now, I'm sure I was supposed to make 13% or 25%. This one I mismanaged. But at the end of the day, we kept plugging, and we end up pocketing $2,000 on $34,000 invested. And I'll tell you what, I also doubled down on the Leaps call options. You can see I originally bought 5, went ahead and bought 10 more. We're reducing our cost basis. See, this is what I show the members. As I'm doing these trades, I find myself in a bad spot, so I have to use a disaster recovery plan. And in this case, it was to buy more Leaps call options and help me come clean on the trade. The members got that email. Let me show you the last poor man's covered call I did with Cisco. You could see this was late last year, November. And oh, by the way, here's all your calculators that will be in your tracker in the description. Now, when I place trades, I'm looking at that expected stock move calculator to determine where the stock could be based on its current IV. Then I also use the calculator that tells me, hey, where will my Leaps call option be priced? Well, I love this trade because it was supposed to be an easy swinging trade. No risk, man. I just wanted to buy that Leaps call option, sell that same one strike out of the money, and make the max profit, and we wash our hands. And that's exactly what happens. What I do is this. When the stock is trading at 47.30, see, I got this to the T. This is when I get involved with Cisco, man, when it's trading in and around 47x. Now, it's trading at 48.44, but we're right in that window. So, I went ahead and bought the 40 strike and paid $8.65. That turned out to be the 85 delta. So I'm running a risk that as the stock goes higher, my Leaps is only moving 85% of that. Well, in this case, it worked out perfect because as the stock moved much higher than 48, I had to buy back the near-term covered call, which cost me more money. And that's fine, because what does that mean? That means the stock powered past my strike price and my Leaps call option was going to bail me out again. And sure enough, that's what it did. As the stock kept moving higher, so did my Leaps call option. I paid $8.65. I ended up selling it for $10.93, and we end up making a cool 9% or $1,500 on $17,000 invested. This is using the poor man's covered call, where we buy a Leaps call option in lieu of the shares, and we then write near-term covered calls as if we own the shares. Now, quick before we get out of here, that covered call premium, whether it be the $1,900 having my shares taken away on this new trade, or the $475 if my shares aren't taken away, I will be buying the QQQY. The QQQY uses the NASDAQ 100. They write options, but they write daily options. So we get more volatility in this ETF, and they're able to generate much higher monthly dividend yields. In this case, the QQQY pays some 85 cents a month. In fact, it's paid as much as $1.10, $1.93, 62 cents, and 85 cents. It's all based on volatility, and the QQQY provides a very healthy monthly dividend. My goal here is to collect some 1,500 shares of the QQQY, doing the poor man's covered call, and then taking those premium profits and buying the QQQY until my dividend garden has 1,500 shares of the QQQY, just rendering me that nice monthly dividend fruit. And I go out with my basket and pick them all every single month, paying the bills, living the good life. Hey, look, what I want you to do is go from the trade mindset to the wealth mindset. We use the semi-passive investment strategy of writing covered calls. We take the premium and buy dividend-paying stocks, monthly dividend-paying stocks. That's the passive income investment strategy. There is your wealth mindset. I want you to have it, because if you have it, you'll have true financial freedom. Hey, look, be safe, be healthy, most important, be lucky. Until next time, may all your covered calls be profitable.